Okay, so today's video would be on accounting ratios. Now you have learned accounting ratios in AS. So here in A2, you have some additional formulas lah. But nevertheless, you cannot forget the AS accounting ratio formulas. They will still be asked. Okay, so let's go through I'll review the whole thing, the AS plus A2. So this is what you learn in AS. Gross margin, gross profit over revenue times 100%. So your answer should be expressed as a percentage. Okay. And then we learned markup, gross profit over cost of sales times 100%. Okay. And then profit margin. So profit margin is profit for the year profit for the year divide revenue times 100%. The revenue here could also mean net sales, as in sales minus sales returns. Okay, but nowadays in the latest past year questions, they use the word revenue rather than sales. Okay, but if sales or sales return is given, then you must take the net sales. All right. Okay. So it can be profit for the year or profit for the year after interest, whichever way. Okay. And then you learned in AS return on capital employed. So NPBI, net profit before interest, or what we call profit from operations. Okay, profit from operation means profit before deducting the finance cost. Okay, so profit from operation divide capital employed times 100%. So capital employed here means capital as in equity, equity plus non-current liabilities. Okay, right. Then in AS, we learned expenses to revenue ratio. So this is the formula, total expenses divide total revenue times 100%. Okay. And then operating expense to revenue ratio, right? So here, operating expense means the excluding finance costs, right? Here it's including finance costs, expense to revenue ratio. Okay. So here it's including here it's excluding finance costs. Okay. Then we also learned liquidity ratios in AS, current ratio as in current assets divide current liabilities. Okay. And then here it's important that whatever answer, whatever value, whatever number must be followed by colon 1. If you just write the number alone without the colon 1, even if the number is correct, you won't get marks. Okay, likewise here, same. Whatever number followed by colon 1. So the difference between current ratio and liquid ratio is that current ratio includes total current assets, including inventory. Here is excluding inventory. Okay. Including inventory and excluding inventory. Okay, then we learned efficiency ratios. Okay, so this consists of non-current assets turnover. So the formula is net revenue divided by net book value, which is now known as carrying value. Carrying value of non-current assets. Okay, so then we learned trade receivable turnover in number of days. So trade receivable divide credit sales times 365. So you need to read the question carefully, because some questions they will tell you that the total sales consists of some cash sales plus some credit sales. So you only take the credit sale portion. Whereas there are some other questions which tell you that the total sales is made up of credit sales only, which means there's no cash sales. Then you can take total sales. But whatever it is, you're taking just the credit sales portion, which may or may not be the total sales. That's what I'm saying. Okay. So likewise, here, trade receivable days, you must always round up. For example, if you get an answer of, say, 32.1 days, Now, mathematically, this is rounded up to 32, but as long as it has crossed a certain integer value, as long as you have decimal, you always round up to the next integer. So this is rounded up to 33 days. Okay. So we are being prudent here. Okay. So likewise, trade payables days. So trade payable over credit purchase times 365. Okay, then we have inventory turnover. So this is the formula, average inventory over cost of sales times 365, right? And then you have rate of inventory turnover, which is cost of sales over average inventory. So the answer is given in number of times, okay? So yeah, this is what you learned in AS. Now in A levels, these are the additional ratios that you need to know. Okay, starting with what we call a working capital cycle. So working capital, in SPM, we learned it as modal kerja, right? So working capital refers to current assets minus current liability. So nowadays you call it net current assets, right? But the name working capital still applies. Sorry. So working capital cycle in days refers to this, the trade receivable turnover in days, as in how many days it takes to collect from trade receivable, plus inventory turnover in days, minus trade payable turnover. Okay, right? So these three components added together, as in these two added and subtracted with trade payable, consists of our working capital cycle. So working capital cycle, it actually measures the time, the number of days from when we purchase inventory until when we collect the money from sales. See, in order to sell, you need to purchase inventory first. Okay. So when you purchase inventory, you're either going to purchase on cash or on credit, right? So after purchasing the inventory, there's no guarantee as to when you can sell it. So this is where your marketing skills needs to be good. So you need to sell it as soon as possible. So after you've purchased inventory, our money has gone outflow. So we need to collect the money back through sales. So if you do cash sales, that's good. But if you do credit sales, then you need to wait for further days to collect the money. So this is what working capital cycle is about. Okay. So this working capital cycle, the lower the number of days, the better. Okay. So for example, if our company's working capital cycle is 10 days, example, and the industry average is 12 days, then we are better off than the industry. Okay. Right. Then we have net working assets to revenue ratio. So net working assets to revenue ratio, this is the formula. So net working assets consists of these three components. It's coming from the working capital actually. So inventory plus trade receivable minus trade payable. The same three components that we use to calculate the working capital cycle. Okay. So this is our numerator. So you need to divide by revenue. So even this one, the lower, the better. Okay, this percentage. The lower, the better. Okay. Then the next formula is income gearing. So this is the formula, interest expense as in your finance cost. Divide profit before interest and tax. Well, simply profit from operation. Times 100%. Okay. So income gearing measures the proportion of finance cost over profit from operation. So the lesser finance cost is in relation to the profit from operation, the better it is. Because finance cost is interest that we have to pay regardless of whether we make a profit or not. So that finance cost should be seen as minimal as possible. So the lower, the better the figure. Okay. Okay, then we have a gearing ratio. So gearing ratio is a fixed cost capital over total capital. So fixed cost capital, actually this one is from the Cambridge website. They haven't updated. Okay, forget about preference share because it's off the syllabus. So fixed cost capital refers to capital that we obtain and we have to pay a cost for it, a fixed cost. So which means a fixed cost capital is none other than all forms of non-current liability, because non-current liability is a form of capital but it's borrowed money and it's temporary and we have to pay a cost. The cost is the interest that we have to pay. Okay, so basically the non-current liabilities divide total capital. So which means the numerator is non-current liability. The denominator total capital means equity. Remember, this is equity plus the same non-current liability. So that's the formula. So non-current liability over equity plus non-current liability. So gearing ratio, this answer is in terms of percentage. The lower, the better. Okay. All right. Then we have investment ratios. Okay. Investment ratios. So usually those investors who are in the stock market, they like to look at all these ratios. Okay. So here are the ratios that you have to know. Earnings per share. Now the word earnings actually refer to profit available for ordinary shareholders. So the profit that is available to shareholders is after deducting everything, expenses, after paying off finance costs, and after paying off the tax. That is profit available to ordinary shareholders. So it's also called earnings. Okay. Again, we can delete this. Okay, this is your profit for the year actually. Profit for the year. So the formula is profit for the year after tax, divide number of ordinary shares. Okay, that will give you the earnings per share. So the earnings per share tells the shareholders, the ordinary shareholders, how much do they earn per share that they own. Okay, so this formula, the higher, the better. Okay, the higher, the better. So for example, if the earnings per share is $10 per share, if you own 20 shares, it's 20 times 10, $200 you earn, is yours. Okay. Okay, the next formula is price earnings ratio. So the formula is the market price per share, the real open market price, divided by the EPS that we just talked about here. Okay, so P ratio is market price per share divided by the earnings per share. Okay, so the higher the better. A high PE ratio indicates investors' confidence in the company. See, it's reflected here. When investors are confident about a company, they would like to buy the share of that company. So that means when they like to buy the share, when they're trying to buy the share, the demand for the company shares is there. So whenever there's high demand, that'll push up the market price, right? So that means your numerator will be maximized or increasing. Okay, so that will increase the entire answer. Okay. Okay, the next formula that we have to know is a dividend yield. So this is the formula: dividend paid and proposed divided by market price of share. So this answer is usually expressed in percentage. So the higher, the better. So this dividend yield tells you the proportion of the dividend that the shareholder is going to get or got already over the market price of share. Okay. And then the next formula is dividend cover. So dividend cover is how much profit is available in the business to pay dividend. That means dividend cover tells us how many installments that the company can pay dividend in the future. For example, if the profit is 1,000 and the dividend is 200, which means 1,000 divided by 200 is 5. So the company can pay out dividend for the next 5 years, for example. Okay. The higher, the better. So this formula is expressed in number of times. Okay. So the higher, the better. And then this formula, the last formula that you have to know is dividend per share. The dividend per share is how much is the dividend per ordinary share that the shareholder has invested in. So the formula for that is ordinary dividend actually paid out divided by number of ordinary shares. Okay, the higher the better. Okay, this is expressed as how much is the amount. All right, so that's all that you have to know in formula wise. Well, we've talked about limitations of ratio in AS, but I'll just go through it again in A2. So ratios have their limitation. You can know whether the financial performance is increasing or is getting better or getting worse, but ratio cannot tell you the reason for that. So to actually find out the reason of the financial performance getting better or worse, we need to probe further. We need to talk to the respective people in the respective department. For example, if let's say the gross profit is declining, last year was 40%, this year is 35%, and we find that the sales value has reduced. We can see that the sales has reduced, but what is the cause of it? We need to talk to people in the sales department. Okay, we need to talk to people in the sales department. Sometimes it might not be anything wrong with our product, but simply because new players have entered the market, and unknowing to us, they would have offered a better price package to customers, and customers swing towards those people. Okay, nothing to do with it's not to say that our inventory is of bad quality, or it's just probably people are offering a cheaper price than us. Okay. On the other hand, it could also mean that our product, that there's something wrong with our product and customers are not happy. So these kind of reasons, ratios cannot tell you. You have to find out from the respective people. Okay, and then for ratios to work, the accuracy of ratio depends on the quality of information. That means how accurate the financial statements have been prepared upon. So if the financial statements are not accurately prepared, then even if you use the correct formula, you are actually not seeing the true picture. Okay, and ratios can only be used to compare like with like, meaning same industry to same industry, and probably same size to same size company. So for example, if I run a construction company, I cannot compare myself with say a furniture manufacturing company. Anyway, why would I want to do that anyway, right? But sometimes for some reason, people want to compare, why some products depend on other products. You know what I mean? Some products, the demand for one product depends on the demand for another product, even though we're not in the same industry. Okay. Okay, so another limitation, is that ratios tend to ignore time value of money. Okay. All right. Okay, so that's it. Okay, now I'll just show you an example of a past year. Okay, I'm looking at this one. May 2023, paper 31, question number 2. Right. Okay, let's get on to that. So I've opened up the insert, the question paper, and the marking scheme. Okay. So here's the question. So directors of Z PLC provided the following information. So for the year ended 31st December 2022, revenue, see you're given all this information, revenue, all on all credit sales. So there's no cash sales here. Purchases, all on credit. Non-current asset turnover. See, this is an AS ratio. They still ask you in A2. Okay, interim dividend paid per share, 30 cents. final proposed dividend per share, 15 cents. And then you're given the gross profit margin, dividend yield, price earnings ratio. Okay. And then you're told that at 31st December 2022, these are all the information: inventory, trade receivable, trade payable, cash at bank, some debentures, ordinary share capital, and share premium. Okay. So, yeah, question number 1. State 2 comparisons which a business may make by using ratios to assess its performance. So, businesses might want to compare themselves with the industry average. They might want to use trend comparison, right? Year to year. So trend analysis, right? So these are your answers lah. Using trend analysis. Trend analysis is where you're comparing the performance of the business this year against previous years. For example, you want to take the past 5 years of gross profit and you want to see the trend. Is the gross profit on an increasing trend or a declining trend, or just not increasing or declining? Not increasing or declining. Okay. So intercompany comparison, this is where the company uses ratio to compare themselves with their peers. Okay, or maybe within their sister companies and so on. Okay, industry average is where the company uses ratio to compare themselves against the average of the industry. Okay. Okay, now moving on to the next part. Calculate the net assets. All right, so net assets means total assets minus total liabilities, right? As in equity, right? So the net asset would be non-current asset. Okay, how do we get 515625? Okay, how do we get 515625? It's because here, using the non-current asset turnover ratio. Here, net revenue over total carrying value of non-current assets. So revenue here is 825. $825,000 over carrying value of non-current assets, which is what we want to find. Divide that equals to 1.6 times. So with that, the carrying value is as per given here, 515625. Okay. All right. See here, we are trying to calculate the net assets. So whichever assets which we are not told the value directly, we have to use the ratios to calculate them. And that's the case of the non-current assets. Okay, then now how do you know that you have to look out for non-current asset? Because of the ratio. You have a ratio for non-current asset turnover. That means you have a non-current asset. That's how I know to pick up the non-current asset. Okay, next, inventory 44,000. Come from here, closing inventory. Yeah, because we want to calculate the net assets at 31st December. Okay, then trade receivable 76,400 from here. Trade receivable 76,400. Trade payable 32,900. Okay, coming from here. We subtract because it's a liability. Okay, then we have cash at bank 81,000. Okay, coming from here, cash at bank. And then we have debentures 100,000. Okay, here it is, debenture 100,000. Okay, so calculating everything, this is our net assets. Total assets minus total liabilities. Okay, Now remember, net asset also means equity. Okay, equity. So equity means capital plus all the reserves. Okay, so this idea is connected to what you're asked in the next section. In the next section, we are asked to calculate the retained earnings. Okay, so now we just calculated the net assets, which is equity. So how do you get retained earnings? The net asset, also known as equity, minus the capital and minus all the reserves that are there. So the balancing figure is retained earnings. Okay, let's see. So the equity figure, following what we got from here, okay, minus ordinary share capital. So how do we get 300,000? It's because here, 300,000. Okay. And share premium, 30,000 came from here. So there being no what do you call a revaluation reserve and no general reserve. So the balance figure must have been retained earnings. So that's how retained earnings is calculated. Okay, retained earnings at the end of the year. Okay, then they're asking you what's the retained earnings at the start of the year. So you need to work backwards, right? Okay, you need to work backwards. So we know that, or rather we should know that uh, okay, so we should know that when you prepared your SOCE, retained earnings brought down as in start of the year, plus profit for the year, minus dividends paid, minus transfer to general reserve equals retained earnings carried down. Okay, so if you want retained earnings brought down, it should be, so you work backwards. So minus becomes plus, plus becomes minus. Okay, so this will be retained earnings carried down plus any transfer to general reserve if there is any. But in this case, in this question, there isn't. Plus dividends paid and minus profit for the year. So that's what is happening. 254125, which is the retained earnings carried down, plus the profit for the year. Okay, how do you calculate profit for the year? Okay, you see, profit for the year is the profit available to all the shareholders, right? So this has got something to do with the profit for the year in this case means earnings. So the earnings per share formula, it's the earnings divide number of ordinary shares. Okay, we know this. We can find this because in the question, you see the value of the share capital is 300,000 and the nominal value per share is $1. So 300,000 divided by 1 is 300,000. So we know that the number of ordinary shares is 300,000. Okay. But we want to know earnings. Okay, we know this is 300,000. But we do not know the EPS. So there's another formula for that. PE ratio is market price of share over EPS. So let's see whether we have this information or not. Okay. Or you can use another formula, dividend, you can use a dividend yield formula. Because dividend yield also contains the component market price. So dividend paid and proposed divided by market price. Okay, let's list this down. Dividend yield is dividend paid and dividend proposed divide market price per share. Okay, let's see which one we have to use. We have market price per share. Okay. Here, we know the PE ratio. It's 18. But we don't know what's the market price per share. It's nowhere given. So we cannot use the PE ratio formula. So we have to take this approach. Dividend yield. Dividend yield, the formula, well, dividend yield is given 4%. Okay. So you can't use this approach. So dividend yield equals to, okay. We are told what is the dividend paid and proposed. If you go here and check, see, interim dividend paid, final dividend proposed. This is the dividend paid, 30 cents. This is the dividend proposed, 15 cents per share. So 30 plus 15. So it is 30 cents per share plus 15 cents per share over market price per share. So now we can calculate, I put as MP, and market price per share would be 45 cents divided 0.04. So you get $11.25. Okay. So now that we know the market price per share, we can substitute it into the P ratio formula. Because we are told what the PE ratio is, right? Price earning ratio is 18. So then we can find the EPS. So price earning ratio, which is 18, divided by market price per share over EPS. So the EPS is, the earnings per share is 0.625. Okay, so this means the shareholders earn 0.625 for every unit of share. But there are 300,000 shares there, right? So now 0.625 is the EPS. So 0.625 equals earnings over 300,000 shares. Therefore, we can calculate the earnings. So the earnings will be 300,000 shares times 0.625. So that's how we get 187,500 as the earnings, which is the profit for the year. Okay. Then the dividend paid was, remember, it was 30 cents per share just now here. 30 cents for one share. So for 300,000 shares, 90,000. So therefore, that's the retained earnings brought down. Okay. Right. Then following through part C, C1, calculate the following at 31st December 2022. Working capital cycle. Round each component up to the next whole day. Okay, so working capital cycle, as the formula put it, is trade receivable in number of days plus inventory turnover minus trade payable. Okay, so trade receivable, this is a working lah. Okay, trade receivable times 365 divided by credit sales. So once again, trade receivable times 365 divide credit sales. So that will give you 33.8. So we round it up to the next day. So we get 34 days. Okay. Okay. Then inventory turnover. So use the formula. Average inventory over cost of sales times 365. Okay. So here, in the original question, they gave you the closing inventory. They didn't tell you the opening inventory, but you can find out. I mean, using AS techniques, because you see the gross margin is 48%, which means the gross profit is 48% of revenue. Therefore, the cost of sales would be 54. 100% minus 48% is 52%. 52% of 825,000 would be your cost of sales. So you know the purchases, you know the closing inventory, so you can find the opening inventory. Okay, that one I believe you can do yourself. So your cost of sales will be 52% of 825. So that figure equals to opening inventory plus the purchase that we know minus the closing inventory that we know. So you can find your opening inventory. So that's how they find the opening inventory. The opening inventory is 68,000. Okay, so the average inventory is, as you learn in AS, the ending inventory plus opening inventory over 2. So 56,000. So the putting it into the formula, average inventory over cost of sales times 365 will give us, after rounding up, 48 days. Okay. All right. And then the trade payable, turnover is trade payable over credit purchase times 365. So after rounding up, we get 30 days. Right. So then the working capital cycle is 52 days. Okay. Then the next ratio, gearing ratio. Give your answers to 2 decimal places. So fixed cost capital divide total capital. So yeah, here's the formula. Fixed cost, as in your non-current liability, divide equity plus non-current liability. So the non-current liability is 100,000 coming from here, debenture. Okay. Divide equity. Okay. So equity plus non-current liability. So okay, the equity consists of capital plus reserve. So okay, this is the capital, 300,000. Now, as for reserve, we only have share premium, 30,000, and the retained earnings carried down that we calculated just now, 254,125 from here. Here. Okay, there's no general reserve, there's no revaluation reserve. Okay, so yeah, so non-current liability over non-current liability plus equity. So this will give us 14.62% to 2 decimal places. Okay. Okay, lastly, so B PLC, Public Limited Company, a major competitor, has a working capital cycle which is 5 days shorter than that of Z PLC. So which means Z PLC's working capital cycle is 5 days longer. So advise the directors of Z PLC whether or not they should be concerned about the company's working capital cycle. Justify your answer. Okay. So maximum 2 marks for should be concerned and 2 marks for should not be concerned. So you should give reasons for why you should be and why you should not be. So since it's 5 marks, 1 mark for decision with comment, and then the balance 2 marks for each side. So if you're talking about should be concerned, yeah, we should be concerned because we're taking a longer time to convert working capital into cash. So this might indicate that we're holding too much inventory. So when you're holding too much inventory, we also have to pay for the holding cost, like in rental, storage, maybe insuring the inventory. Okay. And this might lead to inventory possibly deteriorating because sometimes we might be selling certain kind of inventory which cannot last long, right? Okay. Too high a working capital also can mean we're not fast in collecting from our trade receivable. That means our credit control skills are not good enough. Okay, so we should look into probably offering more attractive cash discounts, right? Or maybe we are unnecessarily paying off our trade payables too early. Okay, all right. Now, so if you say should not be concerned, we can say that 5 days may not be a material difference, may not be much of a difference, unless it's like 20 days difference or 15 days difference, then we should be concerned. We can go on that line. Another reason is we can say that maybe our businesses have different policies in line with the type of business that we are doing. Okay. Okay. Or we can say that we should not be concerned, as there may also be some non-financial factors that has an influence on the financial statement. That means even though the financial statements show that our what do you call it? Our working capital cycle is longer, but maybe we might be enjoying a good relationship with our supplier. We might be enjoying our good relationship with our customers. Yes, maybe they pay us late, but for sure they will pay. We might talk on that grounds. We know better. All right. Okay, so with that would be 5 marks. Okay, that's how you talk for 5 marks. So you work through the rest of the questions on accounting ratio on the May, June, and October paper, and then you'll be clearer. But make sure you know how to do the calculation first, and then sharpen your skills on the theory. All right. So yeah, that's it for today.